Okay, should we talk individual stocks then? I mean, we've talked quite a few individual stocks for what it's worth, but we're ready to talk about stuff that is not in any of our portfolios at the moment, I think.
Sure. It's a sort of stocks for Paul, if you will.
Mm-hmm.
He's not here. So stocks for you at home. Do you want to go first?
Yeah, all right, I'll go first. This is only vaguely a stocks for Paul. I mean, I sort of immediately disqualify myself because this doesn't pay a dividend. So, stocks for... yeah, okay. Stocks for not Paul. Maybe that's why Paul's not here. He saw this coming in protest. This is a company called Verisign. A name like Verisign makes it sound like a kind of knackered old billboard company, but it's not a knackered old billboard company. I think it's actually quite interesting in a number of ways. It has a market cap of about 20 billion, so that's, for context, about the same as DoorDash. But unlike DoorDash, this company makes money. So what does the business do? Well, it provides registry services for internet domains, and if you try and look into what it does, you'll have to deal with a lot of technical sounding stuff about the internet. But what it basically does is register things and provide registry services. So specifically anything with .com or .net. Also, I was looking earlier, any website ending in .name or .tv, so all the big ones, but who cares about them anyway, has to pay and register via Verisign, so that, roughly speaking, the complicated world of the internet can connect up the things that we type into the websites themselves. .org, by the way, which is the other one, is owned by someone else. More on that in a bit. Registry services for the internet are fairly cheap to manufacture or run or something like that, which means it has massive margins. Gross margins are 85.6%, operating margins are 65.8%, net margins are 59.1%. These are big numbers. There are legitimate tech companies that dream of having a 59% gross margin. These guys have a 59% net one. What do we always say about high margins, Steve? The worry with those is...
that somebody's going to come along and eat your lunch.
Basically, yes, someone might well come along and start doing it for less. That person is often called Jeff Bezos. But Bezos isn't going to get to this, and I wouldn't care if he did, because I own Amazon, I don't own this stock. What they do have is a contract with a bunch called the Internet Corporation for Assigned Names and Numbers, which is shortened to ICANN. And that gives them exclusive registry rights on these things. So think of them kind of like a utility, and I'll tell you a bit more about why in a moment then. But they have the exclusive registry rights for .net and .com. No one else can get in their way on that. If you found out these things were protected by contracts, Steve, what would be the next question that you would ask? We haven't rehearsed this, by the way. Let's see how we go.
Sorry, I was typing.
That's all right. If you found out these things are protected by contracts, what would be the next question you would ask?
When do they expire?
See? Didn't even need to listen. Yes, when do they expire? Well, there's news on this. And the news is not good, at least at first sight. The .net contract expires in 2023, and the .com thing expires in 2024. That, on the face of it, since this stuff is a 90-something% of their revenues, basically it's the entire business. They strictly do some other things as well, but look, this is where the kind of whole story starts and stops. That sounds kind of not great. But the good news is there's what's called a presumptive right of renewal on these, which basically means that as long as they meet their contractual obligations, i.e. don't bugger everything up, these are renewed automatically. They are not kind of put out for tender for anybody else to bid on or anything of the sort. And so far they've done a solid job of not buggering things up. For about 25 years or so, Verisign have been doing this kind of thing. So they're a bit like a utility in the sense that they are protected by pretty much monopolistic power over something. The other side of the coin with utilities is, well, there's a couple of other sides to the coin. It's a weird-shaped coin. Is that they're expensive to run. That doesn't apply to Verisign. That's the reason utilities get protection, because they have massive capital outlays that they wouldn't make if they didn't get it. But Verisign's not like that. But the one thing they do have is restrictions on their pricing power. So utilities are not, in virtue of having a monopoly, allowed to just charge you whatever the hell you like for your energy bill, despite what you might be seeing in the news at the moment, and it might feel like that. Verisign equally is not just allowed to charge people whatever the hell they want to register a .com or a .net domain. So when Paul tries to go and register burgundyinvesting.com, Verisign don't just say, well, that'll be £8 billion, like they really ought to be honest. Yeah, they really should in the case of Paul. But they currently charge $9.02 for a .net and $8.39 for a .com, and their, I guess, regulator alike, which is ICANN, allows them to raise that by 10% per year in a .NET case and 7% in a .com case annually. So that means a couple of things. It means that, like utilities, you have very good visibility of what their earnings are going to do, because generally speaking, these things, if you think they will get renewed, we'll come back to that in a second, the price is going to go up by 10% and 7% respectively, depending on which one you're looking at. Okay, all nice stuff so far. Let's talk valuation for a bit. Valuation is okay from what I can see of it. This is a company that's almost never cheap, because something with massive margins and a monopoly and price increases that are almost guaranteed, and all kinds of other things like that going for it, is likely to be fairly attractive. But the market cap at the moment is 20 billion. It has another 1.7 billion in debt, 233 million in cash, and produces $777 dollars per year in free cash flow. So that's a return of about 3.66% when you add all that lot up and divide things by other things. 3.66% is sort of okay. PE is around 25, but with a company with this much debt and a negative book value, I wouldn't use PE to try and value it. I would try and value it based on its cash. I put together kind of three sort of cases here. So bearing in mind we know that they're allowed 10% and 7% contractual increases. They're likely to go forward like that for some time. I've got a kind of worst case here of about 8% average increase, which gives you a 5.3% return over 10 years annually. Their best case of 12%, and that gets you a 6.4% return over 10 years, and a kind of middle case of 10%, which is 5.83% return over 10 years. Their share count, they do like a buyback for what it's worth. They don't do dividends, but they have brought their share count down from 167 million 10 years ago to 109 million now, which basically means they are pulling in their stock at a roughly CAGR of 4.18%, if you want to talk about a kind of yield on this sort of thing. And that means you can sell your stake down at 4.18% and still own the same amount of the overall business, effectively. So you're kind of undiluting yourself in a certain way. What's the risk with this kind of business? It sounds like a nice kind of toll booth thing based on the internet. That doesn't seem to be going anywhere, and I think I'd probably agree with all of that, which is why I like kind of trying to present it now. Here's the kind of, I mean, there's sort of two risks. One, which I think is vanishingly unlikely, which is that their contract doesn't get renewed because they do something scandalous, and that would be devastating for what it's worth, but I don't think that's very likely to happen. So let's leave that thought aside for the moment. The other big risk that I can see, or significant risk, which is much, much, much more likely, is that the rise of apps takes over from websites. So increasingly people feel like they can live without a website. Facebook can do away with a .com thing, and we'll just have an app instead. That strikes me as much more plausible, something that might happen and bother things here, and that would be bad because that's pretty much all Verisign does, is registered domains. I think as long as there's websites, there's going to be .coms. I don't see anything else taking over from that, but there's an issue around the rise of apps. From what I saw in their last earnings report, there's not much reason to think that's happening yet. In the last quarter, they had 1 million new .coms, which is 0.3% in increase in volume over the previous quarter. It's small, but as long as that keeps moving in the right direction, I guess, what you have is enough to kind of give you some clear sense of where the earnings are going to go. With this one. There we are, Verisign. Oh, Buffett owns it. It's like the 13th or so biggest position in the Berkshire portfolio. Last time I looked, they own about 11% of the company. He bought it ages and ages ago. I'd long assumed it was a really boring thing. And then I went and looked at it. I'm just thinking the older viewers, which I'm putting myself squarely in the category of at the moment, may remember Verisign from when you used to buy things on the internet before everything else, because you used to get the Verisign Secure and the Verisign Secure 3D. And that used to be the way that you would put your credit card details, and that would how you pay. And I just had a really quick look at what they did with that business, because I assumed they just got competed out and kind of retreated back to this. But it turns out they sold it to PayPal, which is fairly interesting, for about $1 billion or $1.1 billion. And it was really a case of seeing what they've done with that sort of money since then. And the answer with that is not an awful lot, really. No, not an awful lot.
They're a very, very steady business with a what looks like a fairly impenetrable moat, but it's one of those kind of moats where almost a binary event could kill it off, will kill off the company as a whole as well. But it's a very interesting company. It's trading a bit rich, but I guess, when you look at its actual cash conversion figures, or at least its income conversion figures, it looks really impressive.
Yeah, its earnings are going at a CAGR of about 14 or so %, and the 25p is maybe a little high for that. 25p puts it in roughly, I guess, the same conversation as something like Apple. I think it's I'm not sure. It might be better from what I can see of it. I mean, Apple appears to be... It's less predictable, only because Verisign is extremely predictable, but I'm not sure. I think I kind of like this stock here. What have you got, Steve?
Well, just before we go on, CEO's been selling. Just having a quick look at that. Last month he sold about 4,000 shares. So I wonder what he knows about this bid on the contract that's coming up. But
that's about a year away.
Yeah. Anyway.